This is the Investor Connect podcast program. I'm Halti Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Well, hello, this is Hal Martin with Investor Connect. Today we're here with Eric Berman of E8 Angels. Eric, thank you for joining us.
Oh, it's my pleasure to be here.
Great. So what was your background before investing in early stage companies? What did you do before E8 Angels?
Well, I was a reformed software guy. So my educational background is in physics and electrical engineering, which somehow I've never used directly a day of my working career. Out of college and grad school, I ended up having the good fortune to be at Microsoft through most of the 90s, where I worked on a variety of projects that you've probably seen and used if you used software about 20 years ago. And then I was at Expedia when it spun out of Microsoft in 1999. I was with them for about 6 years, managing various groups. Spent the last few years that I was there as the vice president of product of the basically shopping path at Expedia. So anything that the traveling public would interact with when they're searching for flights, cars, hotels, packages, stuff like that. That was all done by my team. And I left Expedia in late 2005, and I decided that I wanted to work on something that had more of a double or triple bottom line to it, and specifically in the environmental sector, had a large passion for renewable energy and for the environment. But I wasn't sure I wanted to go back to being sort of like an entry-level electrical engineer after my degree was at that point 20 years out of date. And somebody pointed me to what was then called Northwest Energy Angels. And I said, ooh, this looks like fun. What a great way to find the company that I'll want to go work for. And so this was in 2006. And I actually decided, whoa, this is actually way more fun than getting sort of the overview of the sector and seeing companies that I thought were crazy and companies I thought were insanely cool, and sort of seeing what the trends were. And I could put my money where my mouth was on which ones I thought were interesting. And I've just kind of been spending about half of my time ever since then doing that. I joined the board in 2011 or 2012, I don't remember. And so I'm now the co-chair and president of the organization.
Well, great. Well, tell us more about the E8 Angels.
Sure. So we are an angel investing group. And so what that means, I'm just not sure if that's something that is familiar term to your listeners. We are a group of individual accredited investors. And so let me break that down a little bit. An individual means we generally write our own checks. We make our own investing decisions. And accredited means that the IRS we've met the IRS guidelines to be able to, sophisticated enough and have enough assets to be able to afford to invest it recklessly. In other words, we can afford to lose it. And because angel investing, and I suppose that's worth defining too, angel is early stage startups. So this is typically after friends and family and before venture capital. So you've got a proof of concept, but you're not yet selling to customers, and you need capital to actually take what you've proven, what you've demonstrated at a bench scale, and take it out to a market. And that's sort of our sweet spot. And so another important thing about angel investors, of course, is that we are investing our own money. We are not investing other people's money. Okay, so that what angel? So E8 is effectively, you can think of us as sort of a matchmaker. We bring together investors with companies that are seeking investment, and hopefully dating occurs and the occasional marriage. Dating, of course, means that there's a due diligence process performed where the investors investigate the company and decide if it's a worthwhile investment. And you can, in that analogy, marriage is when they write a check. To date, we have invested, God, I don't have the exact numbers off the top of my head. I can look them up here. But it's close to $40 million. I think it's actually 39 point something million dollars in about 90 different companies. Oh, no, it is over 39 million. $39.3 million is what we've accounted for so far over 14 years in something north of 90 different companies.
Wow, it's quite an investment you made so far.
Well, not me personally.
Well, as the
I'm a
group
tiny
itself,
fraction
it's
of that.
they come together and they share the deal flow and the diligence and invest together and so forth. So that's great. So you've been in the angel group for a while, and let's talk about the state of angel investing. How do you see the industry evolving for angel groups? What are the changes you see coming up?
Well, I think angel investing has changed in a few different dimensions. I can talk most about how it's changed in our sector of clean tech, but I think it's sort of a macro level. One thing that you're seeing in angel investing is maturation. Angel investing didn't really even exist as a thing 30 years ago, at least not as a formal thing. And so over the past dozen or 15 years, you're seeing a proliferation of angel groups, often with some sort of a focus. They're focused on female-led organizations or on medical devices or on regional things. And you're certainly seeing a lot of changes in the forms of investment. 10 to 12 or 15 years ago, it was all preferred equity, shares in the company. Today, I think you're seeing actually a lot less equity and a lot more convertible debt and safes. Apologies if I'm using a term of art there. A safe is a simple agreement for equity. It's not debt, but it sure looks an awful lot like it. And you're seeing innovative financial investments like crowdfunding, things like AngelList and Propel X, which I can talk about a little bit more because it does play into a little bit of what we do. And you're seeing alternative investment vehicles, which I personally think is really important for our sector, other than the traditional equity and debt kinds of instruments.
Why do you think you're seeing a lot more convertible notes and safes rather than straight up or preferred equity?
They're simple, they're easy, and they put off the difficult conversation around valuation. And so you're ending up seeing convertible notes and safes evolve to include things like caps and discounts, valuation caps. But okay, so I'll just expose some of my bias. I'd rather just buy shares in the company and have a known valuation. I'm not wild about the valuation being able to float between now and whenever they close their Series A. It used to be the case that convertible debt was a bridge. It was something where the Series A is almost done. It'll be done at the end of April, but here it is March, and we've only got money through the end of the month. We just need a couple $100,000 to tide us over until the round closes. And so you have a short window, and it was usually done with insiders who already had invested in previous rounds, and it truly was a bridge. Now you're seeing a lot of these convertible notes drag on for a long time before they ever convert to debt, which frankly is generally not good for the investor. You can imagine, for example, if you have a note that has some discount and some interest rate, call it an 8 or a 10% interest rate and maybe a 10% discount. If that goes for a year and the company has greatly de-risked themselves in that year and made a whole bunch of progress, they could have doubled in value over the course of that year, and you're getting the 10% interest and a 10% discount. So you're absorbing all of the risk of equity with all of the upside of debt, which is just not it's just not a great instrument. So I'm clearly exposing my biases. I'm sure there are people who love convertible debt and safes. I'm not really one of them, but I'm also not a financial geek, so I can't go into a lot of details about what sorts of deal terms make the most sense beyond that. I'm not really a deal term chess player.
So, but in general, as an angel investor, what's the biggest challenge you face today? Is it the term sheets or is it something else?
No, here I'm really going to speak from experience. It's exits. You'll get different answers from different people, but it's making sure that the company is setting itself up for an exit in a realistic time frame. And that, by the way, is another thing that you are seeing as a trend in angel investing is people trying to set up for quicker exits, where instead of trying to get 100 times your money in 7 to 10 years. Why don't you just try for like 3 times your money in 3 years? Or smaller multiple in a smaller time frame. Get a bunch of base hits instead of a few grand slams. And particularly in clean tech, it's been challenging to get those exits.
Absolutely. That's I think the biggest challenge with startup funding or any venture funding is getting to a meaningful exit. So I can certainly appreciate that with the angel investor as well. But let's talk about E8 Angels. What is your investment thesis there for the group?
So we are an impact investing group. And so we invest for profit, but we do so with a purpose. And the way I summarize it is that our hypothesis is that sustainability and profitability are not in opposition. Rather, they are self-reinforcing. And we're putting our money where our mouth is to prove that that is the case, that there is money to be made doing things sustainably and investing in technologies that enable sustainability. When I talk to people, I often say that, look, advocacy and policy is super important and philanthropy is super important. But at the end of the day, you're never going to deal with problems like climate change and pollution and so forth through those two levers alone. You need market forces. And my favorite example of proving our thesis, unfortunately, it is not a portfolio company of ours. They were angel stage and venture stage before we came onto the scene, but is Tesla, where Tesla is a crazy valuable company. Some people might argue simply crazy. I don't. I love the company, but and people buy the car. They buy a Tesla because it's just an amazing car. It drives really well. It's got all these benefits. I could go on and on. Oh, and it happens to be non-emitting. I think that is the best model of what companies can do, where you demonstrate that you can produce a compelling product that is high value for the consumer, that is more sustainable than other alternatives without a crazy premium. And okay, Teslas are expensive, but one smart thing they did was their initial cars were not competing with mid-range cars. They were competing with expensive luxury cars. So there wasn't actually much of a price premium versus the competition. And I think that's a great example of the kind of thing that we're trying to show. We take a very broad view to sustainability and clean tech. Sure, renewable energy and energy efficiency are core to our investment, but we've invested a lot in energy storage. We've invested a lot in agriculture, sustainable agriculture, water, clean water plays, project finance, and things like that as well. Anything where the sustainability story is not just an afterthought or a footnote to what the company is trying to do. If the company is successful, then you will actually make a dent on sustainability. But I think this is important to note. Sustainability for us is a screen. It is not a metric. In other words, we don't give what's called concessionary returns just because something is green. We won't consider it if it doesn't have a sustainability story around it. Once it does, okay, you've met that bar. We're looking at the financial impact or financial success likelihood of the company. And the reason we do that is, I'm grossly oversimplifying here, is that the total impact you're going to have is the per unit impact of your product or service times the number of times you can turn the crank on that product or service. And if the company can't make money, then the number of times you're going to turn the crank is going to be zero, and therefore your total impact is going to be zero. So you have to be able to make money on your own 2 feet.
I see. Can you mention one or two portfolio companies that have fit your thesis in the past?
Yeah, actually. So we've got probably our biggest investee is a company here in Seattle that is, am I mentioning names?
If you like, yes.
Yeah, okay, so I'll give a shout out to Green Canopy Homes. And I got a disclaimer here. I am a personal investor in the various companies I'm going to mention just because I know them better than the companies I didn't invest in. So Green Canopy originally started after the real estate bubble, back when housing was cheap here in Seattle. And they would buy old homes and give them deep energy retrofits, energy efficiency retrofits, and turn around and sell them. Well, now, of course, real estate prices are sky high. And so they've pivoted and they are doing infill development, so new buildings that are all, at this point, actually all net zero ready, meaning, yeah, you still have to actually hook up the solar panels, but it's all high energy efficiency and is capable of being net zero energy. And they've been doing well. They sell their homes often have negative days on market, and so they're able to get the flow from that. They're really good about coming in on budget and on schedule. And one of the most interesting things from an investor perspective is that they recognized that two things: they needed a lot of working capital in order to build homes. It's not a capital light industry, but that homes are, the other thing was that homes are something that have intrinsic value and can thus serve as collateral. And so they have raised a few debt funds. We thought we were strictly equity investors, and they came to us and said, "Hey, we'd like to pitch debt to your members." And we sort of hemmed and hawed and said, "I don't know. We're equity people," and we let them pitch. And they got tremendous participation in that, which taught us a little bit about the value of alternative financing mechanisms, and that a lot of times it's about finding the right deal and deal structure rather than just writing off a company because they're not a good fit for a particular kind of investment. Another company that we're excited about is, and again, that I'm an investor in, is down in Oregon. It's ESS, Energy Storage Systems. They're doing kind of battery called flow batteries. And they're using, most flow batteries are made with vanadium, and they're doing a chemistry that uses iron. And so flow batteries are big stationary batteries. So they're great for buildings, for surviving power outages, or as backup power for data centers or off-grid scenarios and things like that. So they're not well designed for cell phones and cars. But the cost per watt is very, very low, especially for their technology, and they've been growing gangbusters. So there's two companies. Now let me give one more. There's a company that's earlier stage in California called OnSwitch that I'm, again, an investor in. In fact, one of our members is an employee of. And what they do is they use satellite photography to discover warehouse roofs that don't have solar on them. And then they're doing this using machine learning and AI, so it's incredibly scalable. And the AI not only identifies these rooftops that are candidates for solar, but also proposes a layout and produces a clickable bid to actually install solar on the rooftop. So you, as a building manager, can get this email or phone call with an already ready design and layout and cost to put solar on your roof. And I love that because it's incredibly capital efficient. It's a software play, and it's very scalable. And what a great way of getting deployment out there. And when you asked, you said you were going to ask about trends, and I think deployment is going to be one of the big trends we're going to see in clean tech.
Oh, very good. Well, let's talk about your fund. You have one? Can you tell us a little bit more about it and how it works?
Sure. Our fund is currently closed at the moment, but we launched a small fund, 3 years ago, 4 years ago, a little under $3 million, so not huge. Same thesis as the group, but the beauty of going into a fund from an investor's perspective is you can write one smaller check and get the diversification that would take a lot of larger checks to get if you were to do them individually. It's the exact same investing thesis as buying a mutual fund rather than buying an individual stock in the stock market. We see the same deal flow. The E8 fund sees the same deal flow as the membership. We collaborate on due diligence. We even have a structure where members get a little, if they participate in the due diligence, they're eligible for a kickback on the carried interest for the fund. But the idea is basically just to make it easier to liberate more dollars for more investors. And so this is actually where we as a group are focusing our energy. Historically, we've had one way to invest. You had to be an accredited investor and you wrote checks in individual companies. It's very high bandwidth. You have to attend the meetings. You have to do your own due diligence, and you're typically writing a check that is in the tens of thousands of dollars. So it's very high bandwidth kind of thing. The fund is sort of at the other extreme of that, where you can let other people do that due diligence. You just write your committed capital and you get all the diversification and the benefit. But of course, there's a little bit of a cost to that because the fund does have associated costs and does participate in any carried interest. So you're paying for that, right? I mean, they're providing the value of doing that, and that comes out of your returns. There's a third option for accredited investors that we're doing more of, which is where when we see a deal we like, a member or two may choose to lead it on a crowdfunding site like PellX or AngelList. And we've done this for a few of our companies where we may be writing individual checks to the company as well. And then you can go out onto AngelList and say, hey, I love this company. I'm an investor in it, and I invite all of you to do it. And then you can get accredited investors from all over the world, or at least all over the US. I think it's international. Anyhow, they can write checks, and it all gets bundled up by AngelList. So it's one line on the company's cap table, and we can dramatically amplify our investment into the company this way. What AngelList is doing under the covers is they're forming a special purpose vehicle, an LLC basically, that is the investor, and everybody owns a pro rata share of that LLC and gets a pro rata share of the returns. There's a cost to that as well, but the advantage of that is if your direct investment check is $25,000 per company and your fund check would be $50,000 minimum to participate in 10 or a dozen companies. With something like AngelList, you can often write a check of as little as $2,000 or $3,000. So you can write a lot more checks in a lot more companies and have less total capital at risk. And so that's on the accredited side, but that's all for people who, by definition from the IRS, can afford to lose their investment. Well, the interesting thing is that the IRS, you don't have to have any threshold to have a 100% certainty of losing your money. In other words, anybody can do a philanthropic check. And the beauty of the way the philanthropic side of the world is set up is that if you have a nonprofit that is focused on a particular programmatic area and they have capital, they are allowed, that nonprofit is allowed to invest that money in what are called program-related investments. And so this is something that E8 is launching this year, where we're going to be launching a philanthropic fund. So anybody, not just accredited investors, anybody can write a check from as little as $10 up. That gets donated into a pile of money behind the C3 wall. So since it's donated, they get the tax deduction, and that the donor will never, ever, ever see that money back again. But that money can now be put to use investing for profit in program-related things, so climate-related, renewable energy-related things. The returns from that can go back onto the pile of money and get circulated again. And so we're trying to use that model as a way to increase the pool of investable cash to help more companies succeed in the sustainability space. It's a long-winded answer. I apologize.
No, it's a very interesting fund and a very interesting model. So of all that you have going on, what excites you most right now?
I'll give two answers to that, because I'm seeing, and I alluded to this before, I'm seeing a divergence between traditional innovation investment and deployment investment. And what I mean by that is innovation investment is when you invest in a Google or Microsoft or an Amazon or something, you're investing in some startup that is trying to do something novel that will end up having a hockey stick-like return and changing the world. And that's where traditional angel investing has always lived. you don't angel invest, at least not successfully, in restaurants. But in that space, 10 years ago, we used to see lots of people with innovations in solar and wind. Hey, we've got some new silicon technology that'll help increase the efficiency of a panel by 0.5 percentage point, and that was a very big deal. We're not seeing any of those deals anymore. The solar panels have become commodities, and in fact, they've declined in price so much that they're no longer the majority of the cost of an installation in many cases. And so we're seeing people addressing the soft costs around them, like what I was describing with OnSwitch before. But the area where we are seeing the technology innovation is storage. And I'm very bullish on storage. And so this is batteries, like flow batteries that I discussed, but also lithium ion and other new chemistries. And we've been seeing incredible economies of scale isn't the right word. So the learning curve with even lithium ion, where the costs have been coming down at a Moore's-like pace, and the density has been going up, not quite as fast as Moore's law. Density there you're running into physics, but still have been going up, power densities and energy densities. And I think it is a fascinating area, and particularly as you start getting into the management side of it. When do you charge? When do you discharge? When do you if you have excess solar during the day, can you do an arbitrage of low electricity prices to high electricity prices, and all of the things that it enables for deployment of renewables, for electrification of vehicles and things like that. I think storage is absolutely a hot and fascinating area. But the other area is not a specific area, but it's precisely the fact that lithium ion technology, solar and wind and so forth are becoming industrial scale commodities, and EVs is deployment. And this is the less sexy. I'm not coming up with something that'll win you a Nobel Prize kind of stuff. It's I'm going to get 1 million solar panels on rooftops, and I'm going to get EV chargers at every intersection, and just get stuff out there. So there's no technical risk in this. It's all financing risk and execution risk and project development and things like that. And by the way, I personally think that is for philanthropic capital, I think that's the right kind of investment for that, because you don't have to wait 8 years to find out, with an 80% chance that your company's going to flame out, or and a 20% chance that it's going to do really well. You can actually show returns and show impact within a year, which I think is important for philanthropic dollars. And to the degree that I live in Washington State, we are committed to 100% renewables. And I think a lot of that is just a matter of getting stuff deployed, getting the electrical vehicle infrastructure out there, getting more solar deployed, things like that. And I think that's typically done via financial models other than equity. And I actually think that there's all sorts of great opportunities awaiting us for that.
Well, great. So what's your advice for people investing in startups in the clean tech sector? What do you tell them to do before they write that first check in a clean tech deal?
Well, the flip answer is the fact that it's a clean tech deal doesn't matter. It's all the same risks as investing in any company in any sector. So the cliche but accurate advice is invest in teams, not technologies, and make sure that you understand the business, make sure you understand all the risks, make sure you understand the competitors and so forth. In those regards, there's nothing unique about clean tech. Some of the things that I think are unique about clean tech, one is anything where you're manufacturing stuff is going to be more capital intensive than if it's a pure software play. So make sure that the deal structure is appropriate for that, and the follow-on funding that may be necessary is there. But perhaps, actually, let me take it at a slightly higher level, because I think that the more salient point is that there is a small subset of the population that is willing to pay a premium for green. And I'm part of that small subset. But let me stress, small subset. Most people can't or won't, and that's not a failing on their part. They're going about their daily lives. You have to be able to compete on the merits of the product. If the Tesla Model S example, again, they didn't make trade-offs. It's a great car that happens to be an electric car. And then I think it's also just be aware that the premium you're going to be able to get for being green is small to none. And then the other thing, and again, I don't think this is a real clean tech specific thing, but I do see it a lot in clean tech, is don't confuse a product or an innovation with a company. They're not the same thing. A company exists to solve a problem space and is not married to any particular technology or innovation. And you see a lot of companies that they were in a lab at some university and it's some brilliant researcher or something, and it solves a problem today with a particular technology, and that's awesome and wonderful. But in 2 years, you got to ask yourself, what's next? How do you pivot? Microsoft was not a DOS company or an operating system company. They were a software company. Amazon is not a book selling company. They are a retailer and now a cloud service provider. So make sure that the company has opportunities to pivot and really understands the business that they're in, not the technology that they are in love with.
Well, great. And on the other side of that table, what's your advice for startups that are beginning a clean tech company? What would you tell them to do before they launch?
I think it's actually the exact same advice. Don't drink your own Kool-Aid. Don't convince yourself that people will pay a premium because what you're doing is good for the planet. By all means, make it good for the planet. And that is a differentiator. And all else being equal, if you're sustainable and they're not, that's amazing. That you're going to win if that's the case. But you've got to focus on solving a real customer need. Understand your sales cycle is an important thing in the clean tech sector, because we see an awful lot of B2B plays where your sales cycle is long and you have a couple of dozen potential companies you'll ever sell to. That's a big red flag for investors. So an example would be someone who's got some big innovation in battery electrodes. That's super important. Electrodes are a limiting factor in batteries right now, and that can be absolutely positively huge. But there's a few dozen battery manufacturers in the world, and they're all going to think long and hard before betting on some startup in a garage for their core technology. So it's better if you can. It's generally better if you can do one thing a million times than if you make 1 million sales of something than if you make 10 sales of 100,000 each, if that makes sense.
It does. Well, in the last few minutes that we have here today, what else should we cover that we haven't?
Let's see. I managed to sneak in my argument for thinking about deployment, I will say it is important, I think, to think about figuring out how to match the deal terms to the deal. Obviously, a terrible company don't invest. But for a lot of companies, they're good teams and they're good companies, but they're not an equity play or even a debt play. Don't stop. Think about, are there alternative models for financing? One of our companies is interesting. So I guess a meta company, one of our portfolio companies incubates other companies that are impact companies, and they have a revenue-based model for the companies that they nurture. So they get a piece of top-line revenue from each company alongside a little bit of equity. And it's a way of getting their money back. It's one of these early exits, so you're getting lower return, but much more quickly and much more reliably. So it's a risk-reward trade-off while still maintaining a little bit of the upside. And I think it's a brilliant way to take more chances on more companies without being quite so hit driven. You can have a lot more base hits, and you have a lot fewer strikeouts and a lot fewer grand slams. And I think it's a great approach. And it's sometimes we get into our box of, I'm an angel investor, and so I'm only going to look at a particular investment type.
Great. So how best for listeners to get back in touch with you?
Email is great. I'm on LinkedIn. I think you said you're going to publish my email address. So that's generally the best way to reach me.
Great. We'll put your email and website in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thank you. I'd be happy to.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Hall Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.